Welcome to Total Money Management. We're going over the week that was August 1.
We're into
Wait,
August.
ends August 1.
August 1.
Where did it start?
Tariff time.
July 28 to August 1.
Ding, ding.
I
Tariff
can't
time.
believe it's August. Already.
Believe it, mate.
Yeah, well,
I'm in disbelief.
Mate, Santa's coming soon.
yeah. Well, we just knocked off Christmas in July, didn't we? Some people had... Oh, the lady at the local coffee shop.
Yeah.
They
I want
love-
Santa
they
to
love
bring
me
me
up
some
there, mate.
Don't know.
I'm a
200,000.
local legend at the coffee shop. Anyway,
Which one?
I won't
And
bore
the
you with that
RSL.
story. Mate, I can't disclose
What do you
this.
want for Christmas? I want $200,000 bitcoins.
I want a market crash, 40% minimum.
You're right. Few thousand people losing their jobs and stuff.
I just want a break, mate.
You just want.
Yeah, all right.
I can see.
I only had 3 months off the podcast or something, maybe 4.
more. I think
Is it out for long service league?
it was
Mate,
only. How do you two go last week without me? didn't kill each
it was,
other?
It was tough.
Yeah,
It
Tough.
was a slog, mate.
didn't have the
Yeah,
gel.
we didn't have that English humour there.
Yeah,
Oh,
Yeah.
well, you got me.
Yeah,
next
we
time.
started to get on each other's
Tom
nerves.
couldn't even get the bloody camera working.
Well, there's no video.
There's no YouTube video last week,
Okay,
right? Couldn't even
hang
get
on
the
a
camera
second.
working. How's that?
You've spent more time here and you couldn't get it going.
Mate,
All right,
I keep saying to you, I'm 62. I'm not supposed to know about these things.
I'm the stock guy.
You're 30. You're
Yeah,
like
true.
supposed to be in the prime of your tech life.
It's the only reason I'm here.
Righto,
It's
okay,
the tech.
let's get on with it. Lots of trade deals. I'm not going to go through the trade deals because, quite frankly, they're changing like you change your underwear.
Taco.
Once
It's-
a week.
Well, no, it's not. It's not taco. It's just, Trump does what we all do, right? You go in when you want a salary negotiation. You say, "I want $1 million." They go 200,000. You go, "Yeah, okay." I mean, you just go for the highball, right?
When was the last
When
salary
was the last
negotiation?
time
It's a bit
you
of a
pitched
jump,
$1
I
million?
admit that. But
The guy with no job.
Yeah.
Anyway, back to the serious stuff. Yes, there's lots of trade deals because today, Friday, is August the 1st. That was the deadline, and so. But overall, like I got to say, he's knocking a few of them over. He's got Europe, Indonesia, Thailand, Vietnam, Cambodia, the Philippines, Australia, the UK. Like he's doing all right.
Get him in line.
And he's had a shot at India. Excuse me, today he had a shot at India and basically said, well, India's always a bit tricky. They're always a little bit like, oh, we want to be friends with the Russians, but we want to be friends with the Americans too. And so Trump, because they're buying Russian oil, right? And it's really cheap. So Trump is saying, well, if you want to be with the Russians, fine. Piss off, go and be with the Russians. But, you can't have it both ways.
They just want a good deal.
Well, yeah, but India will be one of the places that will stand to benefit, right? Because a lot of the Asian countries would be going, fantastic, right? They're going to get it out of China and they're going to bring it to Vietnam. This is great for our country, right? So they'd be looking at it going, great, we love this stuff.
Well, the market had a bit of a negative reaction today, well, especially in Australia, but in the US as well. And it's probably one of the first negative reactions that we've seen in a while of the tariffs.
A little bit, yeah. The tariff day, the volatility overnight in the US was because of the tariffs,
Yeah.
right? That's the thing. And now I think...
I mean, did you see copper a couple of days ago? Lost 20%.
Yeah,
overnight.
25.
Insane.
Yeah. But remember what we said a few months ago where we said this is what would happen, right? Which is Trump will make pronouncements and companies and commodities will go, zit, down 30%, up 40%, right? And we're going to see more of it. And that's what makes it a little bit hard in picking individual stocks. That's what makes it really difficult.
Through the floor.
Yeah.
Oh, you didn't short copper?
I didn't, not this time. No.
So,
I'm surprised.
Anyway, we'll just it's just a rolling clown show.
So he's kicked it down another week.
Yeah, for some of them,
For
I
some-
think. Yeah.
I think Mexico he gave a bit of a leeway on.
Yeah, he obviously hates Canada, because he's given them a bit of grief. But they'll come around to a deal. It's like all of these countries are like, oh, this is outrageous. Okay, we want to do a deal, and the Americans know that they're the biggest market. They offer basically military protection, So, you can be all hairy-chested, but the fact is that half of these countries wouldn't be on the map without the US.
Yeah.
So, they cannot, and a lot of, all politics is local, right? So everyone's got to go, oh, these tariffs are terrible. Oh, we're outraged. And it's like, yeah, righto, roll over. There's not much you can do.
Well, there's no talk about war anymore.
Well,
The wars are over.
Yeah,
We're just desensitized to the war.
Yeah.
well, Trump has really changed his point of view on Putin.
Right.
I think Trump, really did believe he'd be able to swing Putin around. And Putin has just gone, no, we're not doing a zot. We're going on with it. And I think that's where Trump's gone, right, okay, now I know he's actually not my friend and I need to arm up Ukraine. But the Germans are stepping up as well. Like the new German Chancellor, he's also basically gone, right, okay, we need to get our act together. Right?
in terms of building.
Well, in terms of military
spending.
in terms of Russia, right? Because they know Russia wants to sweep east, right? So the Germans know that they need to rearm because you've got to remember over about the last 10 or 20 years, the Germans have basically, disarmed, right? Which is the dumbest thing to do, but there you go, they're German. So, that's what happens.
Good job, only 0.1% of our listeners are German.
Yep. Oh, well, we've lost the one reader in Berlin.
Stop getting us cancelled, Steve.
Oh, God.
Done this a few times.
You guys are so soft.
Softies.
You're so soft.
Just big softies. We just want to cuddle.
We just care about our
Righto,
customers.
Come on, get on with it. The red wine's soaking in.
Well, we've got more analysts saying greed is good, just as we're ticking back over euphoric levels in the stock market. I think it's worth, we talk about, this is episode 96, I think, and we talk about it in probably 95 of them, that when we get to these levels, it's worth being cautious, and we've been at these levels for a long, long time.
Yep.
Is there anything else you want to add on the topic, or?
It feels like a melt up.
Yeah.
Yeah.
You look wrong until you look right. Okay, and the problem is you can look wrong for a really long period of time. Jeez, it's
say
gonna be
that a bit
hard.
quick.
Can't get this out after a couple of wines.
We're just broken clocks
Yeah, well, but it is
waiting to be right.
It is true. But I think I can't remember. I think it was one of you guys. I said, well, we're still making money. It's just not that we're not 90% allocated
in NVIDIA.
in NVIDIA. Yeah, and so unlike basically when you look around the world, everybody's in NVIDIA.
Yeah.
This week it's worth 4.4 trillion. I mean, that's Jesus, that's absolutely insane.
My opinion, still undervalued.
Well, thanks, Tom.
Tom's opinion.
Tom will be away next week, folks.
Greed's good. Okay.
But in all seriousness, the newsletter we're going to send out in the next couple of days is just a bunch of charts, because I think I might have said, Tom, last week, I was just scrolling and went, oh man, Cape ratio 39, Buffett indicator 220. Oh Jesus, margin debt, $1 trillion. Oh my God, investor sentiment through the roof. Shit. NVIDIA, 4.4 million. Oh, my God.
Every alarm bell is like...
Mate, there's nothing that you can go, no, that's reasonable.
No, it's all blaring, so we just put headphones on, soundproof headphones on, and then you don't hear all the noise.
It really gets back to our point about not losing money,
Yeah.
right? You hear a lot of these people with that platitude, oh, don't lose money, but, they don't actually make adjustments to their portfolio that actually says, I won't lose money, right? They're all just riding it, right? Yeah. That's why I'm a bit dirty on the industry, because they speak about all this sort of stuff, but then they're just all bloody fully invested. You lose 50% and they go, oh, well, no one could have seen it. And it's like, oh, okay.
Yeah, sure.
Well, the latest argument against Buffett being terrible is that he sold, obviously, a lot last year, whenever it was,
of
of
Apple.
Apple, and he's missed out on all these gains in the last 6 months. Look at how much money he's missed out on and lost.
A bloke who's been investing for 80 years
Yeah,
ain't
yeah.
going to be worried about the next 6 months.
He did exceptionally well out of Apple, and he will keep his money.
Yeah,
when
he
the
hasn't
market
lost a
drops.
cent. He hasn't lost a cent. It's not invested. And he's made so much money from the investments that he sold.
That is what keeps people in markets too long.
What's that?
Just worrying about losing out on
Yeah,
potential
FOMO.
gains. Like,
Yeah, the FOMO
if
stuff.
you sell and take profit, like, you haven't missed
Reinvest.
out on anything. You've
Well, there
actually
was-
secured the profits.
There's a famous investor, like 100 years ago, Bernard Brush, I think his name was, and they said, how did you get rich? And he said, I got rich by selling too soon, right? I.e., I just kept making profit, right? And this is the problem with people being over allocated, right? That you're only over allocated at the top of the market when the Cape's at 39 and the Buffett indicator, blah, 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 and you're all in, right? And that's because people don't pay attention and to market cycles. So you're up, see this cycle, America's gone from, March 2009 to now is about 460%, right? Which is a pretty standard bull market, right? But you think about it, you lose 50%, that absolutely severs your returns back to about 6 to 7%. Well, that's an average return, right? And the way to make money is to avoid the downsides. But to avoid the downside, you've got to be prepared to say, okay, like you were saying before, Warren Buffett's not sitting there going, oh man, I sold too early. I mean, he knows the deal. The market's crazy. That's why he sold.
To avoid the downsides, you've got to be prepared to lose some of the upsides.
Well,
Not lose, miss out.
Miss out, yeah.
yes, but in actual fact, if you think about it, you don't miss out.
No, because if it does drop, then you deploy your cash and you've picked them all up for cheap.
Yeah, and what happens is, these ones with Buffett and Apple, Apple falls, 35% back below where Buffett sold it. Now he looks like a genius.
Few bill gets
Right, and that's what I'm
redeployed.
saying. People say, oh, you're missing out on the returns. It's like, no, it depends when you sell. Now, if you sell at the top, good for you. That's great. But there ain't a lot of people that sell at the top.
And
Right.
investing's a lifetime journey as well. Like obviously, Buffett's towards the
Yeah.
end of that now.
Yep.
But most people invest for 30, 40, 50 years if you're lucky.
Yeah.
So you
Yeah.
just
And
let it
again,
play.
this is the thing too, where you got to understand that investing is not a one-time thing, right? That's where it's different from property. Property, you buy a property, that's it, right? The next move on that property is selling it. With stocks, you can buy stocks and then you can sell some. If it falls, you can buy some. So you can rebalance, and that's why stocks are better than property. Now, you're not going to beat property in a bull market because you're going to leverage the buggery out of it, right? And you'll make heaps of dosh. No argument there. But the fact is, over a lifetime, you can rebalance stocks, right? If you buy a house for 1.5 million and it falls to 1.2, there's nothing you can do about it, right? You can't say, oh, cool, we'll buy some more. Well, you can't do that. You can do that with stocks, right? So that's the crucial difference that nobody talks about, right? They always go, oh, over 20 years, stocks made 8 and property made 7.2. It's like, so what? That's completely irrelevant, right? Because you could buy and sell stocks and go, actually, I made 9.7, right? Through the act of rebalancing. And that's why we sort of say you can make money choosing the right stocks, or you can make money out of the process of allocating and rebalancing, right? And doing simple stuff on indexes, right? Country indexes like we do in Well 2 and the ETFs we use in Well 3, right? That's the process of investing, right? Whereas lots of people are out there trying to pick the right stocks, and we know that 85% of fund managers don't beat the market. So the argument, there's so many studies out there that just say basically it's a loser's game. It's ridiculous. If you looked at those track records, and finance fund managers had to have it in big print saying, here's our performance, you'd look at most of them and go, we're not giving you any money, because they can't beat the market. It's just crazy.
They just tell you to buy and hold and then make up excuses as to why buy and hold's the best.
Well, yeah, but what they do too, Jacob, is they build funds that pick stocks, right? And what you see in a lot of finance publications is the winners, right? Oh, here's Here's Total Money Management. They've made 17% for the last, 7 years. And here's Steve, and here's how they did it, right? Next 7 years, Steve fades away and makes 2%, right? But you don't hear about the losers. Like, you don't pick up those things and go, oh, Total Money Management, they've made 1% for 7 years. Let's hear how they did it, right? Like, let's list their top 5 mistakes, right? I mean, money just flies out the door. So that's what I mean. You get all of this bias by listening to all the good bits, right? Not the bad bits. And that's where I think it's a little bit naughty.
Oh, anything finance is a marketer's dream because it's money and everyone's attached to it.
Yeah.
So anyway, Aussie Soil, Labor members are calling on Jim Chalmers to kind of cut the 50% capital gains tax. And what is that, in an effort to kind of curb housing prices?
Well, yeah.
What are we trying to do? We're obviously trying to raise a bit more cash because we've got $5 billion in lost revenue.
Yeah.
They're trying to find places to raise revenue, right?
Yeah. Essentially, I think what's happened is, and I think I explained it on the week that was video out tomorrow, what's happened is since the election, because Albo won with such a huge margin, what people thought, or what some people, not everybody, but what a lot of people do is go, oh, well, you've got a big margin, you should do all of this, right? But I can tell you, in politics, you can't go to the people and say, listen, we're going to do this, and then you get elected and go, actually, we're not going to do that. This is what we're going to do.
Well,
right?
that seems to be what they do every single time, though.
What's that for?
That seems to be what every single party does every 4 years.
Empty promises.
Well, a little bit, yeah.
That's the game.
What you do is you say, oh, we're going to get in and we're going to fix the budget, right? And then you get in and go, oh, my God, they've left us a huge black hole, so we're going to have to, really cut down, right? That's what they do. So on this occasion, what I'm noticing more and more is talk about how the government should raise revenue, right? Should we cut the capital gains tax? Should we raise the GST? There's you mentioned, Tom, the Victorian government.
Oh, I saw an article, not trying to spread FUD, but
fear-mongering.
7 News, leaked policy proposal includes property sales tax for Victorians. That's not set in stone by any means, but it's interesting. Is that talking about the capital gains discount?
Yeah.
Is that what that's
Victoria's got a big budget hole, right? But the problem that there's a political technique called running the hairs. Well, Wayne Gosh used to call it that, right? So what you do is, let's say I'm the Premier and I want to bring in, I want to lower the capital gains tax, right? And you guys are think tanks that are friendly to me, right? So I get you guys to put it out into the public going, the government should be cutting the capital gains tax, right? I sit here and go, well, that's not our policy. But I look
see what happens.
If everyone goes, the government should be doing that, you go, yeah, right, okay, we'll have to look at this, because the budget looks terrible. If everybody goes, this is outrageous, terrible, this is disgraceful, you go, look, it was a suggestion from people and it's, that's not in our policy platform, right? So that's the way you sort of test the waters, right, is what you...
It's weird. I mean, I feel like any changes that they make to kind of slow the property situation down is going to piss a lot of people off.
Absolutely.
So, if that's...
Can't wait.
Yeah.
Well, remember,
it'll happen just after you buy. You'll get dream plays of Milady.
Remember John Howard said, this is 20 years ago, Howard said, no one's ever come up and complained to me that their house price has gone up.
Yeah.
Right? That was, and he's right. That's why the government are in such an awful position. Because and the other thing is too, they can only do so much. The fact is the Reserve Bank is in charge of interest rates, right? Not the government. So, Albo's not forcing you into the property market or into buy a bank loan. And what I mean by that is saying this is where people get this thing about government and go, well, the government should fix it. Okay, all right, we'll fix it. We'll have 100% capital gains tax. Oh, that's bloody outrageous, right? And it's like, okay, well, you wanted me to fix it, right? But the thing is, the government can't stop you going to the bank asking for a loan. If you're an investor, or if you say, hey, Jacob and Elle, we got married, now we're going to go to the bank and buy a property. It's like, okay, well, Elbow can't say, oh, Jacob, you shouldn't be doing that.
Yeah, I don't want you doing that.
Well, he's got no control. That's where I think, investors do this, right? In the stock market, they do it in the property market. Oh, someone else made me do it, right? And it's like, okay, well, no, they didn't. You did it because you were getting greedy, right? That's what's going on. And so, but it's easier to blame the government because the Reserve Bank is an independent entity. But a lot of the people who are now blaming the government are the same people who said the Reserve Bank should be independent. So it's like, guys, you can't have it both ways, right? So but overall, I just think what's happening is I can just see little ripples about tax, about raising revenue. I can just see them starting to appear in the headlines about how do we raise revenue.
Wasn't there meant to be some sort of income tax breaks that never really eventuated, or they were so piss weak?
That was stage 3 Morrison's.
I'm just telling you, I didn't notice the breaks.
Oh, well, you earn so much bloody money, mate, so you'd never notice it.
Yeah.
Shouldn't I notice it more?
No, it's just a drop in the ocean.
No, it was no. What happened?
They did bring it in.
What happened was Morrison. The deal was that the low and middle income earners would get the first lot, right?
That's why I didn't notice it.
Stage 1 and stage 2. Yeah, now look at his face, right? Want to move along, son? Want to move along now? But in stage 3, the big money was going to be for the high income earners, but only because of the money they earn, right? And what Albo did was inverted it and said, righto, we'll give most of the money to the low income earners and we won't give much to the high income earners. And it was enormously popular, right? Because Australians are concerned about the level of inequality that's going on, right? And that's what's holding out a lot of people out of housing markets, cost of living stuff, right? Rich people don't care what the price of milk is. Why would they care? They're earning lots of money, right? It's the poor people that go, man, things are really expensive.
Bet you still get pissed off about it, don't you, Jacob?
The milk's way too expensive.
Milk situation. You having black tea now?
I actually am. But
moving right along.
Yeah,
both of you are guilty.
Before you bring up anything else, there could be another little melt up maybe with rate cuts coming maybe next month.
Yeah. I think.
If anyone has any buying power left,
there's a couple of things going on there. I think one is the association that rate cuts are blowing asset bubbles. There's some truth to that. It's not totally 100%. The other thing is too, I've noticed there's a few people in property now who are actually sort of saying, oh, you need to be a little bit careful. Right? Do you know what I mean? Like people who...
Well, people in property are selling their own properties.
Yes. So that's where I think if you want to watch the experts, have a look at what they're doing. Yeah. And, it's easy to recommend stuff when other people are putting their money at risk.
We'll just keep buying stocks and doing.
Yes. We'll be all right. Anyway, do we want to do the lesson?
Yeah. Well, do you want to talk about volatility?
Well, let's understand volatility.
Yeah. Can you give us
It's such a fun subject on a Friday night, volatility. Where would you want to be? Where else would you want to be?
Well,
okay.
It's that or geometric returns.
Yeah. Easy, Tommy. One step at a time, son. What I'm trying to get across here is the impact. We've talked a lot about volatility. Liberation Day, remember, was like super duper duper volatile.
Yes.
And that will make people freak out. Right, when the market moves 10% in a day, which is not that uncommon, right? It happens quite a bit. It happened a lot in COVID in 2020.
Yep.
There was movements of 9%, 3 days within about 2 weeks, but then there were 2 days where it went back up about 9%, right? So you get this huge volatility. What I'm trying to point out to people really with this is saying, if you look at and please go and grab the chart because I don't really feel like explaining this because it'll take me 20 minutes. But the higher the volatility, the less the return. Okay? Now, when the Cape is at 39, like it is now, volatility is about 30 to 40%. Okay, so I'm going to do a real shortcut here. If there's 30% volatility, all you do is you go 3 times 3 is 9, divided by 2, that's 4.5. So that will knock off 4.5% a year in returns. So your 10% normal return, if you buy at a Cape of 39, your return is probably going to be more like 5.5.
Is that because it's the whole thing, like, which is obvious when you say it and think about it, but people often don't join the dots. You know, if the market goes down 10%, you start with $100. You're now at 90. If it then goes up 10% the next day, you're at 99.
That's right.
Yeah.
It's the multiplication, right? So again, we go up 20% from $1 to $1.20, right? That's a 20% win. Now, if you go exactly 20% down, it's not back to $1.
No,
it's
96.
96, okay? So what I'm saying is you look at that volatility and go, hang on, I'm worse off, right? So Cape at really high levels can have volatility of 40%, right? Okay, so that's 4 times 4, 16, divided by 2 is 8. So now your 10% average is 2, right? So what I'm trying to highlight to people there is saying when the Cape's really high, you're going to get a lot of volatility, and the volatility is not on the upside, right? It's on the downside. So every time there's a loss, you've got to get a fraction more to get back.
Yeah.
When you get the bigger the loss, the more you've got to do, right? So a 20% loss needs 25, right? A 30% loss needs something like 42. A 50% loss needs 100. And that's why we're saying you can have a bull market where you make 500%, not uncommon, but you lose 250 of it in the decline when the Cape goes from 39 back to 15, right? So now you look at your returns and go, I didn't make 450, I actually made 200 or 250. Then when you go, oh, actually we made that over 20 years, oh, actually we didn't make anything much above the average because of the big loss and the scale that it has.
And because you were too top heavy when the Cape was high.
Yes, and that's why I said at the start of the program, when, you know, the one thing you don't want to be is over allocated, right? So it's the same in any asset market. You know, you don't want to be holding a property where you're totally all in, right? And then go, the market's moved, right? And then you go, now we've got to try and sell. And the market's sinking really quickly. Right, it's exactly the same thing. You know, the only thing you got an advantage with stocks is you can click a button,
And that just doesn't happen with property.
Yeah, well,
It
property
just
only
never
goes up,
Let's put a
So
fifth
there's
bedroom
that.
on.
according to people.
Well, did you want to go through a question or two on socials?
Well, I'll just
anything
deal
more?
with the lesson from history.
There we go.
Just talking about the psychology of the market, and like we talked in the newsletter, the psychology at the moment is cryptocurrencies are going gangbusters. Meme stocks are back. The US market's undefeated. Now I'm seeing stuff like, tariffs don't matter. Earnings are still going to be great. The Magnificent Seven, right? Nvidia's undefeated. You know, all of this stuff is getting a psychology of everything's going to be okay, right? And that's when you know you've really got to start to be careful, right?
Feeling invincible.
Yes, well, and that's what's happening, right?
Yeah. And if you subscribe to The Week That Was, you'll see we've got the chart up for the psychology of a market cycle. We'll put it into Google. You can find it absolutely anywhere.
Yep.
But it's so true.
At the top, it's just a picture of Tom being invincible.
Double bicep.
All right.
Just disbelief. Just constantly in disbelief.
There's one question on the socials, which is just someone asking how do they get exposure to cheap countries cheap ETFs like emerging markets and things like that. How do they get exposure outside of the Australian market into other markets? Like, what are some decent platforms to use?
Oh, okay. Yeah. I see what you mean.
Well, we spoke about the quilter returns in last week's episode.
Yeah, no. This question is saying, because I think I answered it, but in Australia, on the ASX, there's like IVV, which is the US S&P.
Yeah.
There's a Korean one, God knows why, but there's a Korean one that you can access. There's F100, which is the top 100 companies in the UK.
Yeah, FTSE, yeah.
If you say to me, Steve, I want to buy Thailand, it's like, okay, you got to go to the New York Stock Exchange.
Yeah.
Right. And to do that, you can do it on most platforms are pretty good these days, like, ComSec, Interactive Brokers, CMC Markets, all of those. Generally, they'll provide you access, right? What's that other one? Self-Wealth, all of those ones, right? So all you do is go in there and type in, TUR, right, the Turkey ETF, and it'll come up and, New York, NYSE, full colon, TUR, and you can click on it and buy it.
And if you want to see all the tickers, you can go to something like the Novel Investor, and you go to sectors.
Just Google it.
Yeah.
Just Google Turkey ETF, because there's these days there's, Turkey might only have 2, but if you want to buy US sector ETFs, there's like 10. There's US Explorers, there's US Petroleum, there's US Explorers and Petroleum, right? Because you've got to remember, ETFs are private, developed by companies, right? So, companies just want fees. What'd you say?
So go on, get it out.
Yeah. Well,
Today.
I'll get there. But and so those companies will just put out an ETF that they think that will attract fees.
Yeah.
Yeah.
Right. So that's why, 2-3 years ago you had, the medical marijuana ETFs and the robotics ETFs and the Mag 7 ETF, all of that stuff. It's just companies saying people are buying stuff. We need to develop an ETF, market it, get funds in,
Collect the fees.
charge 1.5 or whatever it is in fees.
I was dubious about asking this question. I'll give you 30 seconds to answer it because we're going to be here all day. Have you heard of the 18-year real estate market cycle?
Yes.
No comments?
I'll answer it in 3 seconds. Okay, any other questions? No cycle is that predictable. If it was,
Got him.
you wouldn't have. Yes.
Instantly triggered.
If it was that predictable, it wouldn't be a cycle, right? Because people would go, "Oh, I'll just wait till the 4 years when the market declines, and then I'll buy."
I'll buy on year 19.
Yeah. And the
There you
last
go.
one is, what do you think to tearing up the coal and gas export contracts so we can bring some manufacturing back to Australia?
What do I think about the what? Coal and
Gas export contracts.
oh, jeez,
It's a very
how long you got?
specific question.
That's a bit curly.
Thanks, David.
The coal ones are okay. There's a lot of controversy about gas exports, and it's a bit complicated after 32
I think
minutes
it's
in the
more
show.
about, do we bring manufacturing back to Australia, and does that help?
Yeah, my argument is probably no, because we're too far away from everybody, and the other issue is too, Australia does have a competitive advantage with resources, right? So, you think about it. All of these countries now are knocking themselves out to build stuff, right? Fridges and cars and all that sort of stuff, right? And I understand that's fine. But the reality is they still want iron ore, they still want rare earths, and they still want copper, and they still want wheat, and they still want gold, right? Well, we're here. Doesn't matter where they go, right? The Japanese came to us after the war and said, hey, we want all your iron ore. We went, oh, okay. The Chinese came to us and said, hey, we want all your iron ore. And we went, hey, okay. Now India's going to come to us and say, hey, we want all your iron ore. And we're going to go, okay. So that's always held us fairly steady against, Japan was the manufacturing powerhouse, right? Now it's struggling a bit because China took over. Germany's also competing. Now Vietnam's coming on stream. Now India's coming on stream. So what I'm saying is we've got a bit of competition, right? Brazil, Canada, but we've still got quality resources, particularly our coal and iron ore, which is easy to do, and we do have a lot of expertise in mining, there's a lot of people who diss mining, but there's a lot more to it, right? There's how you get a mine up and running, the machinery. There's a lot of stuff to it. Water management, explosives management,
and we're ahead of most of the world on that.
Absolutely,
subject.
Absolutely. Seismic activity, how you find it, all that sort of stuff, right? We sell a lot of that stuff overseas. But a lot of people like to diss us because it's like, we don't build our own cars. And while that's a shame, it is a bit like, well, Jesus, I can buy a BYD for, really cheap from China. Why would I bother making it if we can make more money by
in other sectors?
Yeah, doing iron ore or some other stuff.
Doubling down on the stuff we're great at.
Absolutely.
Yep.
Okay. Anything from you, Tommy?
No, just want to thank everyone who's taken the time to rate the show on Spotify and comment and engage with it.
Thank you.
Noticed a pretty awesome difference, so appreciate it.
Yeah, keep doing it. Thanks, guys.
Helps a lot.
We love you.
See ya.
Cheers,
Thanks.
folks.
As always, remember, we don't provide financial advice.